let me switch focus. We're joined by Jairam Vadaraj, who is the Managing Director at ELGi Equipments. Plenty happening in this space, and therefore what we want to understand is how things are playing out. Mr. Vadaraj, great having you.
Great to be here.
First, let me start off by kind of getting a sense from you as to what the lower US tariff means for you, because you've got a very large component of US exports within your total revenue basket. What was happening before this 10% or 18% agreement? And now, how does it change for you in terms of the tariff rate impacting your numbers?
So, the tariff journey really started April of this year, and it started with 10%, moved to 25, and then it hit 50. We've been working on multiple projects, not specifically in anticipation of the tariff, because that would be a little prophetic to say that we did anticipate this. But it was very fortuitous for us because all these initiatives that we had developed, for instance, our own motor development, internalizing the motor, certain technology change shifts that we did, all helped us with significantly countering the impact of the tariff. So even at 50%, we're quite comfortable in terms of absorbing it and still maintaining our profitability. Now, having said that, we don't know where the tariffs are going to level out at. Assuming they don't level out at 50%, we'll be in a good wicket in terms of profitability.
Okay. And what does it do to demand, sir? Does demand significantly start to rise? How should that play out? Because this should give you some bit of leverage, right?
So, our business is not like a price elastic business, where you lower prices and you get immediately higher volumes. The margins that we have been able to garner by virtue of, cost competitiveness, we will use it judiciously wherever necessary to increase share of the market, but it's not something that's going to immediately show up in our books.
And for the moment, the margins are getting absorbed at the customer end. So is that the right way to read through this?
No, we did a marginal price correction like everybody else did in the US market, but close to 80-90% of it was internal cost compression. Some of it is at a material cost level and some of it like at our overhead level. For instance, we have now over-indexed our investment in solar, and that's a significant reduction for us. So there are multiple pockets on which we've compressed cost and being able to, like I said, 90% of the tariff we've been able to absorb through that.
So you're telling me that without margin compression, you've been able to absorb 90% of the tariff? Am I understanding this correctly?
Absolutely.
And yes. Now that the tariff unwinds, you've already compressed your costs and therefore margins should go up?
Yeah, like I said, margins will go up, but we don't know at what level the tariffs are going to level out. So I'm not in a position to say this is what it is. Now, are we going to use that margin that we have now got additional to strategically increase our share of the market? Yes, we will do that. But it's not like an instant game because we are not in a business which is consumer and price elastic. So it will be a journey, but it's a positive situation to be in.
So apologies, I'm going to take a step back because I'm a little bit surprised with regard to how this is playing out in terms of the conversation. Give us a sense. Yeah. What was the tariff rate on the products that you were selling in the US? Because that's a large compression to absorb internally.
Absolutely. So we didn't have a duty before. So it is now 50%. So I'll give you some broad breakup on how we've been able to absorb this. A huge part of it came from internalizing motor production. Now, 60-cycle motors made for NEMA standards for the US market are very, very expensive motors compared to 50-cycle motors. Now, When we developed our motor production, we also incorporated the designs for 60 cycles. Now, when that happened, we've got a huge compression in our cost to the extent of 15 to 20% on our overall sales number level, right? In addition, we have done some engineering changes, which we have been doing as part of our overall progression, not in response to tariff, and that has given us another 10 to 12%. Now, solar has given us another 4 to 5%. There is a travel cost optimization that's giving us another 2 to 3%. So we have about 7 to 8 buckets from which we've been able to absorb these, right? Now, out of these 7 to 8 buckets, primarily 2 or 3 have been in relation to work that we commenced maybe 3-4 years ago, that is now fortuitously landing now. And that's something that was timing-wise very great for us. The balance 4 or 5 buckets, which are relatively smaller in value, are all things that we have initiated in the last 8 to 10 months.
Okay, so that's very, very unique to hear, the kind of compression that's happened on the cost side. Talk to us about growth, therefore. Now, I'll switch focus to the top line. Domestic growth, how is it shaping up? Give us a sense. How does this cost compression give you a leg up with regard to US growth as well? Give us a sense on both of those.
So domestic growth has been good. Our overall growth story from a CAGR point of view, we've been able to maintain it over the last maybe 5 to 6 years. Our biggest challenge is to increase that growth rate by another 5 to 6%. And these are the incremental growth opportunities that we're looking at. As far as India is concerned, the story is very strong. We need to wait and see how the trade agreement with EU and the tariff settles in the US and the consequential trickle-down impact on all our industry that we serve. We'll have to wait and see. But I'm reasonably confident India has got a strong position. Second, in India, we are entering into the bottom of the thing, which has been dominated by cheap Chinese imports. Those numbers have been going up. We made a strategic decision to enter that with specially designed products for that market. Those products are doing exceedingly well, and we'll do a formal launch sometime in the early part of next financial year. So the India story is strong. Europe is a bit of a struggle for us because the overall economic situation in Europe is muted. We'll have to wait and see how that pans out. But we are reasonably sure that there will be that marginal growth that we've been experiencing in the past to continue. US has been strong for us so far. It is very surprising, but it is the fact. Now, are we increasing market share? Probably a little bit of share growth has happened for us. But we really need to amp our presence in the US, and that's something that we are working on, multiple initiatives to make that happen. So overall, I think our growth story is positive, but we are working on certain strategic initiatives, still too preliminary to talk about them, to get that additional growth that we are aspiring for.
Very interesting story, Mr. Varadaraj. Talk to us also about 2 pieces. I'll roll 2 questions into one. One is with regard to EU and its profitability. How likely are we to expect some strong profitability to emerge from the EU basket? Of course, you said growth is a bit of a headwind. Also, second, I'm trying to understand about Chinese pricing, because likely that's one of the reasons or one of the big competitors to you. So I'm trying to understand how that is kind of taking shape and evolving.
So to address your first question on EU, our primary focus right now is to get to a point where we are not losing money anymore. So that point has been achieved. Now we are looking forward to growing the business without increasing the overheads that we have learned from the past, that the opportunities are less, so we need to be very measured in terms of our investment in costs. So the coming financial year would be more of, a muted presence in Europe. Now, I think in another couple of years, Europe will start delivering reasonably good profits. That's the expectation that we have. Now, the Chinese compressors are not our biggest competitors, not at all. We play in the upper tier, which constitutes 70 to 80% of the market in India. Now, the bottom of the pyramid, where the Chinese manufacturers have been dumping their products in India, that is beginning to increase in percentage, and we want to get into it before they become too large. And we'll be able to come up with an extremely competitive product, price-wise, performance-wise, quality-wise, far, far ahead of the Chinese. So we're quite confident of that.
This has been a wonderful conversation. Gives us a great sense of how Make in India is playing out in the global market.
Thank you very much.
Thank you so much, Mr. Varadaraj, for coming in and speaking with us. What we'll do is slip into a very short break in the middle of all of these corporate conversations. Stay with us. More action to follow here on ETNOW.